Hello and welcome everybody. You're in the right place. We'll just wait a second while we make sure everybody enters from the waiting room. Okay. Hello again and welcome everyone. My name is Todd Brogan. I'm the Director of Campaigns and Organizing at the International Trade Union Confederation. It's the ITUC, and I'm joining you today from Brussels in Belgium. The ITUC is the global voice of the world's working people, representing some 191 million workers in 169 countries. And it's a particular pleasure to moderate today's webinar, which is called Democratic Backsliding, Key Considerations for Global Investors, which is hosted by the Global Union's Committee on Workers' Capital, or what we call the CWC. For the past several years, the ITUC has been running a global trade union campaign for democracy, so we're especially excited to see the CWC and all of you taking a serious look at the threats democracy faces at work in our societies and around the world. And today's discussion comes at a particularly important moment, an inflection point, as one of our speakers put it in her blog post. The headlines around the world show growing geopolitical uncertainty, pressure on democratic institutions across every region of the world. And at the same time, many investors are working to better understand and mitigate the risks posed by this, including the systemic risks that can affect long-term resilience. Against this backdrop, in this webinar, we hope to support investors in better understanding how weakening democratic institutions can shape long-term investment risk, and we'll also explore some possible responses that investors can take. And before we kick off, just a few housekeeping notes. We encourage you to use the Q&A function in Zoom. You'll find it in the More panel or at the bottom of your screen, depending on which type of device you're using. And you can submit questions throughout the session, so you don't have to wait till the end. And today's session is being recorded and can be shared with you upon request to the CWC. And we've also cleared the sharing of the presentation slides with all attendees after the webinar. So with that, I'm going to first get us started by welcoming Dusty Ngwane, who is the CWC Chair and Trustee of the Mine Workers Provident Fund, to deliver his opening remarks, and then we'll move to our panel. Dusty, the floor is yours.
Thank you everyone for joining us today. My name is Dusty Ngwane, and I'm the Chair of the Global Union's Committee on Workers' Capital, or the CWC. We are a global network bringing together over 600 labor activists and trustees from over 25 countries. Together, we promote the responsible investment of workers' deferred retirement savings, or what we often call workers' capital. I'm very pleased to welcome you all to this discussion on democratic backsliding, which our panel will explore in more depth, but generally refers to the state-led weakening of institutions, structures, or norms that support democracy. Before we kick off, a few words about me. In addition to being the chair of the CWC, I'm a retired trade unionist and a pension fund trustee of the National Mine Workers Provident Fund. The Mine Workers Provident Fund manages 47 billion rand in asset value on behalf of the miners across South Africa. As a retired trade unionist who spent decades defending workers' rights, I want to firstly underscore that democracy and the rule of law are not abstract political concepts. They affect the daily lives of working people. Strong democratic intuitions provide the scaffolding that can help support workers' rights and interests, such as freedom of association and collective bargaining, fair wages, and independent courts and enforcement mechanisms. I would quickly like to give you a snapshot of what is happening in my country, South Africa. Capital is restructuring the economy while organized labor is too weak, too divided, or too silent to intervene decisively. Retail is casualized, hospitality is fragmented, platform work is expanding, labor broking, outsourcing, subcontracting, and informalization have become normal. South Africa's unemployment rate was still 31.4% in the fourth quarter of 2025, with 7.8 million people unemployed. It's a very unpleasant situation indeed. As a pension fund trustee, I'm also coming at today's webinar topic from an interconnected, though somewhat different perspective. This webinar will explore the risks democratic backsliding poses for investors, including collectively funded schemes such as pension funds that are responsible for stewarding and investing workers' capital over the long term. For a trustee, this matters because we have a fiduciary responsibility to deliver on the pension promise. Developments that could affect the long-term stability or integrity of the environments in which pension funds like mine operate is something we need to better understand. There are two broad areas that I'm looking forward to hearing more about today. Firstly, I'm interested in understanding the linkages between democratic backsliding and the rule of law. The rule of law is what gives us certainty as pension funds that we are operating in a system where contracts are upheld. When the contractual environment that we are operating in is undermined, this raises concerns about our ability to duly administer pension payouts to millions of workers. Secondly, there's the question of investment risk and how our investment in markets where democratic backsliding is taking place will be impacted. These are complex issues that require thoughtful responses and continued dialogue amongst investors, academics, and policymakers. Workers must also be central to this dialogue as workers' deferred retirement savings are pooled to power global markets and they are the beneficiaries of pensions. I'm looking forward to hearing from our speakers on how investors can better understand, navigate, and respond to democratic backsliding during this period of global uncertainty and change. Thank you again for being with us today, and I look forward to the conversation.
Thank you so much, Dusty. With that, I'm going to move directly into our panel of speakers, and we're going to do this in two parts. The first, we're going to just try to understand the problem, the link between democracy and markets. And in the second part, we're going to talk about what we can do about it and what kind of action can be taken. So joining us today are Ashley Hamilton Claxton, who's the head of responsible investment at Royal London Asset Management in the UK. Hi, Ashley. And Lena Mosley, who's the director of the Princeton Sovereign Finance Lab at Princeton University in the US. So first, let's go to Lena. We just heard from Dusty, who's a pension trustee, about that perspective, about how democratic backsliding is affecting not only workers' rights, but also workers' pension security. And so to start for us, can you help us define democratic backsliding? Because it has a term that includes a lot. So please.
Sure. Happy to do that. And I will just say that I prepared a lot of slides. I promise I'm not going to sort of take you through all of them, but they'll be available afterwards to kind of unpack some of what's here. So I should say it's a particular pleasure to be here. I do a lot of research on the politics around how governments borrow money, but then also how investors think about risk. But the other thing I've done a lot of research on in the past was actually the link between labor rights and multinational production. So this is the perfect sort of thing for me. I'm a political scientist, and in political science we think a lot about what democratic backsliding is, right? And so we typically think about this as being sort of reduced integrity of democratic values or institutions. Often sort of the state itself or the government itself trying to eliminate political institutions that are important for democracy, such as rule of law or judicial independence. And one thing I think it's important to keep in mind is that when we think about democratic backsliding in the context of kind of established and stable and longstanding democracies, people sometimes have in their mind that, it looks like a coup, or it looks like, sort of stealing the election on election day. But in fact, in these more stable democracies, that have experienced democratic backsliding, it's often a process that unfolds somewhat slowly. And so it also then kind of can be this kind of weakened oversight of the executive, by other branches of government. It could be sort of restrictions on judicial independence or the independence of the central bank, sort of reducing media freedom and sort of media consolidation. And the point here is that certainly while we might see electoral manipulation, these are the kinds of things that often sort of unfold slowly. There's not a kind of blatant seizure of power that happens all at once, but it does erode rule of law and the accountability of the government. Just to kind of think about this in a global context, there's a lot of scholars who try to measure the degree of a country's democratic institutions, and then also thinking over time about when those deteriorate. So if you're interested in this, there's an outfit called VDEM that does lots of expert surveys and lots of analysis of what's going on all around the world. And for the last few years, they've been pointing out that we're seeing more sort of deterioration of established democracies than we are seeing sort of democratization of autocracies or hybrid systems. And so the general trend that we're seeing in the world is an erosion of democratic political institutions. And so if you think about sort of, how well is liberal democracy doing worldwide, this chart would sort of a fully liberal democracy would be there in dark blue. A full autocracy is there in dark red. If you just take the snapshot from last year's data, we have lots of democracies worldwide, but we also have places, including the United States, where those democratic institutions are not what they once were, right? And so the concern is that trend may well continue. Thanks, Todd.
Thanks so much, Lena, and I'm glad you mentioned VDEM. We did our own analysis last year using VDEM data and sort of the relation to the strength of trade unions and workers' rights. So we're regular readers, and we saw the report this year, and it's not a pretty picture. Lena, I want to keep the focus on you for a second and talk about the evidence. What kind of empirical evidence is there to establish a link between the strength of democratic institutions and market stability? And do we already have evidence that suggests what the financial implications of this backsliding might be?
Sure. Oops, sorry. So one way I think about this is that there's a lot of academic research which links political institutions, and that could be domestic, thinking about sort of democracy and rule of law, as well as kind of international, the way that we've governed the global economy, among other things. We know that when those political institutions weaken, there are negative economic consequences, and there's a pretty substantial body of research that sort of investigates the mechanisms by which this occurs. And so I tend to think about this in three kind of general categories. Again, happy to unpack these, and I'll provide some slides that have a bunch of citations as well. But the first of these is that to the extent that a country has weaker rule of law, we tend to see a sort of reduction in and an undermining of investment. And so if we think about the idea that long-term investors are thinking about their ability, for instance, to ensure that their property rights are protected, to be able to kind of settle disputes in a legal system that is fair and efficient. To the extent that those things don't exist, we're going to see reduced levels of investment. That doesn't mean, of course, that places with weak rule of law don't get any investment, right? Because there are other factors that matter. But there's a lot of evidence to suggest that all else equal, when rule of law is weaker, we're going to see lower levels of investment. And we can think about that with respect to kind of longer term or foreign direct investment. We can also think about this with respect to kind of shorter term investment, where there's some nice research establishing, for instance, that democratic governments are better able to borrow money on international markets than their non-democratic counterparts. And especially when sort of global conditions are tight, when there's a lot of uncertainty out there in the world, being democratic gets you better access to credit. So that's kind of one piece of it. A second piece of it is that to the extent that there is uncertainty with respect to sort of government policy, government's commitments to the rule of law, or again, to things like a certain level of trade policies, we see that asset markets of various sorts respond negatively to that. So, the easy way to think about this is investors want to know what the future is going to look like, right? And to the extent that we instead are in a world in which, a government might do one thing one day and then sort of reverse course the next day, or it might not sort of be following the established rules, then we see a lot of disruptions that happen in various, again, short-term and long-term markets. And we see a sort of reduced willingness of businesses to make longer-term investments because they don't know what that policy environment is going to look like down the road. And of course, this is going to trickle through and have implications as well, not only for investors, but also for workers. If firms aren't making investments, they're also probably doing less with respect to hiring. And then the third channel I think is worth thinking about is that while not every government that would engage in democratic backsliding is necessarily of the kind of populist variant, and not every populist government is a backslider, there's often a strong correlation. We might think about Jair Bolsonaro or Viktor Orban in Brazil and Hungary, respectively. Populist tend to have sort of platforms that are not only sort of anti-elite, not only anti-immigrant, but also kind of anti-globalization, anti-economic nationalism. And that matters here because many of those that will engage in democratic backsliding also seek to unroll the sort of global economic integration that's been a hallmark of the last 70 or 80 years. And, to the extent that things like a rules-based system of international trade has allowed for economic growth, we have pretty good evidence that all else equal, when populist governments are in office, economic growth and all kinds of other things suffer. And they suffer not only while the populists are in office, but they suffer for another 10 to 15 years after the fact, right? Compared to a kind of comparison group that's otherwise similar but didn't have those populists come into office. And so I would just say, there's a variety of mechanisms through which we would expect that democratic backsliding is going to be problematic from the point of view of economic growth. And I'll leave it there.
It's really compelling. Thank you, Lena. I'm going to turn to Ashley, but Lena, we do have a message for you in the chat on slide sharing from CWC.
Gotcha.
Ashley, earlier this year, you wrote a post, and I read this just last week, that claimed that democracy and the rule of law is the defining ESG issue of the year. Can you unpack that a little bit more? What's the link between democracy and good governance, and why this stands out for you as an ESG issue?
Sure. Thanks, Tom. Or Todd, sorry. Yeah, so just a quick maybe introduction to me and Royal London. So Royal London is the UK's largest mutually owned pensions and life insurance company. So we're owned by our members. And why that's important is because, and we are the asset manager for the mutual. Why that's important is because we are managing the capital of many of your pension schemes, maybe not yours specifically, but many workers' pension schemes. And so there is a real alignment with workers, with pensions, and recognizing a lot of the money we manage is on behalf of workers' deferred wages. And as a mutual, we are managing our money and our business for the benefit of our end members. So all of the profits that we make go back into either improve our services or as a member dividend. So we have really good alignment with workers. Now back to the blog. So I'm a political scientist by background as well. I happened to land by accident in investment. Did never thought I would work for an investment company, but I wrote it really because going back to my roots of political science and sociology, but also I really was becoming alarmed at the malaise around our democratic systems and the norms that we've established over the last 80 years, as Lena pointed out. And I was also quite concerned about this sort of move towards this sort of strong man, this crony capitalism, this populism, which again, we've always seen ebbs and flows of. But I think what I've sort of observed as a non-academic expert is this is becoming normalized, and it's becoming normalized in democratic and legal systems. So as both Dusty and Lena have pointed out, our modern democracies are really founded on the free and fair elections, on separation of church and state, on separation of executive power from judiciary power, and appropriate checks and balances. And that system is the underpinning of much of our modern economy, as Lena's pointed out. And as Dusty clearly pointed out, and the underpinning of our socioeconomic stability. And I think this is taken for granted today. I think it's the belief in the functioning of the rule of law really sustains this system. And I really think this system is under threat. And I think Lena's much more rigorous academic work shows this sort of empirically. But where I came from is just A, feeling quite passionate about it, but B, also sort of sitting at the intersection of sort of ESG sustainability and investment. So I'll give you a couple of practical examples. So in the US, clearly there are a lot of challenges in the US, but what we've seen is a politicization of the courts. And one example of this is what's happening in Delaware. And why is Delaware important? Well, 2/3 of the US, the largest US companies, as most of you probably know, are incorporated in Delaware. And what happened in Delaware last year is they passed a law that gave significant protections to controlling shareholders. And what you saw in that is a real significant effort by private equity, by the corporate lobby, with significant backing and lobbying effort, really to galvanize around that law. And I think that's had lots of cascading impacts. At the time, the Chief Justice actually issued a warning in Delaware against undermining judicial independence, which is quite unusual. And I think what you saw in that is a lot of technocratic interest groups and lobbying trying to influence the outcome. So related to that is this sort of dynamic that's been happening between Delaware and Texas. So Delaware is where most companies go to IPO to have their incorporation. Texas has been vying for some of that business. And one of the things is around the change in something called forced arbitration. So what happened in 2025 is the SEC, it used to block any IPOs of companies that required forced arbitration. And forced arbitration basically means you cannot fight out your grievances between shareholders and management or directors in the courts. You have to do it behind closed doors. And in 2025, SEC reversed its policy, not saying it's allowed, but they basically said it's not unallowed. So it made it ambiguous. And it also then makes it quite ambiguous in Delaware. And I think what's happened with this Texas dynamic is also Texas has basically said it will allow companies to come to their market requiring forced arbitration. Now, there are absolute positives to some of this forced arbitration because there's been an escalation in cost of shareholder litigation. Sometimes litigation, can be quite frivolous. But I think what you're seeing is this sort of dynamic between real lobbying around corporate law happening in Delaware by really entrenched interests, corporate interests, and changes to some of these technical rules actually really massively erodes shareholder rights. So that's sort of one interesting example and dynamic about how the more democratic systems could be undermined and could impact you as shareholders. When I wrote the blog, one of my team members challenged me and said, yeah, but Ashley, China makes loads of money. Companies in China are making loads of money. China's not democratic, so like what gives? And I think Lena will probably be able to refute this with evidence. I couldn't refute it with evidence, but one of the things that is very interesting about China is, we've been investing carefully in some companies in China, but for certain companies in China, when you invest in them, you are investing in what's called a variable interest entity, or a VIE. And a variable interest entity, if you're as an external shareholder, a foreign shareholder, that means is you don't own the assets of the company. So if the company goes bankrupt, if there's an issue, you don't have a claim on the actual physical assets or the intellectual assets of the company. What you own is a right to a contract. And what that means is if you are relying on the judiciary system within China to enforce your contractual rights. So as an ESG team, we have had lots of deep conversations with our fund managers. If you're going into China, you need to understand this. This is your number one governance risk. If this company decides they're just going to do what they want to do and take your assets off you, you almost have no recourse unless you can go to the Chinese courts and enforce contracts. But there's not the democratic checks and balances that maybe allow you to do that. So that's the second example. And a very brief third example, and it was triggered by Lena's comment about sovereign examples. So obviously, as she said, companies come to the debt markets to raise capital, the UK, the US, Canada, and others. We will invest in their bonds, in sovereign bonds. And one of the variables that we've been looking at and feeding back into the investment teams has been democracy and the rule of law, and some of these sort of factors that, again, is not going to make or break an investment case, but is really important for the fund team to understand when they're giving them our money.
Thanks so much, Ashley. Okay, we've learned a lot over just 15 minutes or so. So I want to take a moment to pause and hear from the people that are actually attending and listening to this right now. So we've heard our speakers outline how the weakening of democratic institutions can shape long-term investment risk, and now we want to hear from you. The poll question is up on your screen. You can select one of these 4 options now. How is your organization currently addressing investment risks related to democratic backsliding and the rule of law? 4 options: not currently considering this as a distinct investment risk, monitoring it but no formal strategy, active stewardship, or unsure. So I'll ask you to please take a moment right now, click one of the options on your screen, and then we'll review the results in just a second. So as you vote, I'll set up the second section. So I said at the beginning, we're going to try to understand it in the first 15 minutes, and in the second, we're going to try to talk about how we take this awareness now and turn it into real action. Before we do, let's see when we can get the results. And here we go. So 39% of the respondents said they're monitoring the issue but have no formal strategy in place. 33% have active stewardship around it, which is very good. 11% not currently considering this, and 17% unsure. So I think this just reinforces how timely this discussion is and how important this discussion is, because we see people across the spectrum of consideration. So Ashley, I want to come back to you now. We're in awareness to action. That's what we want to move to now. In your view, what's the main barrier that's preventing investors from translating this awareness? As we saw from the poll, there is quite a bit of awareness. Over a third are actively doing something. How do we translate this awareness of democratic backsliding into concrete stewardship action? And is there a practical way to sort of overcome this?
I'm really heartened by that poll, actually. I thought everyone was going to be either unsure or not doing anything. So that's amazing. What a great group of people. Barriers. The number one barrier is people perceive it as political. And when you sit an investment manager, a big thing I get sometimes, well, not so much these days, but a big thing that people get really nervous about, and I'm not a US asset manager, I'm a UK asset manager or a mutual, but is, oh, that's quite political and we don't get involved in politics. Which absolutely is important. You know, we will have members that we service that sit across the political spectrum. So I completely understand that. But I think the key thing on this one is to really turn that, this is not about your political party, but this is about the system that enforces, that supports our entire socio-political and economic system. And so I think one of the barriers is getting people to understand that it's not about who you voted for or which side of the left-right spectrum you sit. So I think that's one barrier. Certainly when I wrote my blog, actually, I wrote it and I was feeling quite passionate about it, and I thought, I should probably just get the boss to check this one because, you know, it's just a little bit on the edge, right? And he was actually perfectly happy to send it out. In terms of turning it into action, so I would say there are quite a few things that you can do. It sounds like actually people on their call are doing lots, and maybe they're doing more than we are. And I'd be super keen to hear what other people are doing. But I would say you can pay attention to what's happening in Delaware. I think in the Delaware courts and Delaware elections is really important, even though it's like a small state in America. You know, the US capital markets is some ridiculous amount of global capital. Most pension funds will be hugely overweight US equities. So what happens in Delaware really, really matters to pension savings. And I think it'd be interesting to see this sort of Delaware-Texas dynamic. So far, only a handful of companies have moved from Delaware to Texas. Tesla in a high-profile one, and we voted against that, and a few others. Coinbase might be another one. practically speaking, when companies want to reincorporate, you can vote on that change. So we voted against the resolution for Tesla to move its incorporation to Texas. The resolution still passed, but you can have that vote, and you can ask your asset managers to vote on your behalf that way. So I think that's quite a practical thing that you can do. I would also say to stay actively engaged and support your voluntary checks and balances. So in the UK, we have something called the Corporate Governance Code. There will be similar codes in other jurisdictions and markets. In the US, there's no such code, but there's various investor networks that try to enforce sort of good governance expectations on companies. The name of the organization is escaping me, but it will come to me. So stay engaged with those, and I think any changes to corporate governance standards in the country where you're investing is likely to follow some of this democratic backsliding. And we've seen this in the UK. We've seen a number of very large company chairmen really pushing back against investor stewardship, and this isn't very effective. It's wasting a lot of our time. We need to be growing our businesses. Why we have to answer to these shareholders? We've seen that happening in the UK, and so what we can do is really doubling down on those good governance standards and on stewardship standards. So maybe less common in markets would be stewardship codes like we have in the UK. So I think you can work quite practically in either your local market or with the ICGN, so the International Corporate Governance Network, which is a network of investors, or within CWC, to really kind of support those voluntary mechanisms for good governance, good stewardship. So those are a couple of practical examples.
Very helpful. Thank you. While the news in the past week or two has been a lot about the instability in the UK, I do want to focus this conversation with you, Lena, on the US, where we're starting to see, where we've been seeing signs that democratic institutions and the rule of law are deteriorating. What implications does this have for global investors, and what do you think investors should be doing right now to respond?
Thanks. So let me start by saying that, there's an entity out there called Bright Line Watch that has been doing surveys of the public in the US, but also of political scientists and now of law professors to kind of get their sense of what's going on in the US. They've been doing this since 2015. And in the slides that I'll share after the call, we see that these assessments are kind of the most pessimistic, that they've been about the state of US democracy, right? And so I do think that there's pretty good evidence that things are not going in the right direction. We in the US, I think, tend to often be guilty of kind of American exceptionalism. Even when we do kind of statistical analyses involving lots of countries, we often throw out the US because they are kind of a weird outlier in many ways, given the role of the dollar and all these things. But I think that exceptionalism can get us into trouble because it gets us maybe not thinking enough about some of the threats that are posed by backsliding in the US. And, really, if we start to break down what this means, we could think about rule of law. We could think about constraints on the executive branch with regard to fiscal policy, but many other things. We could think about the fact that democracies tend to be more transparent, right? And so transparency, rule of law, executive constraints are all, again, sort of things that help to enable investment. I think it's good to sort of go back to something Ashley said, which is that when you hear people say we don't want to be political, I think what they mean is we don't want to go sort of left, right, in an ideological way. But the threats that we're seeing now are not about left versus right? They are about threats to the regime and as threats to the political institutions, right? And being able to sort of, make the effective case that that's different than Democrat, Republican, right? It's about undermining the institutions of government, and that's something where it's important to not sit on the sidelines. So I would argue that the US, for many investors, is especially US-based investors, US is overweighted, right? There's this documented home country bias. People hold too many US assets. And so that means, of course, that to the extent that something happens politically that generates a crisis or generates financial problems in the US, there's going to be a hit there. But the second thing to keep in mind is that the US is central to the global economy. And when crises occur in the US, as they did in 2008, those get transmitted globally, right? And so the US financial system can transmit risk to other places in the world. And so you have both this kind of primary effect where democratic backsliding can have negative consequences in any country, including the US, but you also have the secondary effect. And in my mind, that really generates a responsibility to think about the political risk associated with US investment. Finally, then, to this question of what to do about it, there's an old book by someone named Albert Hirschman that was published in 1970. And he was thinking generally about people who are in organizations and something happens that they don't like, and what do they do? So he wrote about consumer behavior, for instance. The book is called Exit, Voice, and Loyalty. And the idea is that when something happens that you don't like, one option is to simply walk away. That is to not invest in the U.S. A second is to say something, right? And then of course a third is to kind of sit and wait and ride it out. And one thing that people have used Hirschman's work to think about is that to the extent that you either threaten exit or you actually exit, that also is a way of kind of having voice. That is to say that if, some investors might feel like, well, we don't want to say something, we don't want to sort of put ourselves out there. Maybe no, maybe people don't say anything, but you can also sort of vote with your feet, right? Or vote with your money, right? And so one could imagine that some investors might feel comfortable making statements in concert with other investing entities. They might also think about rewarding via investment firms that are willing to take a public stance via their own actions. I think it's also important to think about what the corporations in which one invests are doing, right? So that is to say that to the extent that you know about corporate lobbying expenditures, let's make sure that those firms are sort of doing things that are consistent with the values one would want to uphold, right? Certainly, we see that, for instance, some firms have made contributions to those in Congress who were election deniers, right? And that's probably something that ought to be avoided, right? But I think that it's really useful to think not only about exiting places where political risk seems to be creating the possibility for negative economic outcomes, but thinking about using that voice as well. Thank you.
Thank you so much. The election deniers is there's been some interesting reporting lately too on sort of what the condition of those companies is over time. Before I go to you, Ashley, I just want to remind everyone, as they have in the chat, to use the Q&A function. I already see we have a couple in there, but use the Q&A function, put your questions or comments. I think from the poll, we're all interested in also hearing from some of you what actions you're taking and what you're doing. So please use the Q&A for that, and we'll come to that very shortly. Ashley, so given the potential risks that backsliding is posing, in practical terms, what can investors expect of portfolio companies in the context of this backsliding?
Yeah, thanks. I think I'll come to that one in a minute, but I guess responding to Lena's comments around exit, voice, and loyalty, I quite like that. I will pick that up. It's a very common debate within our company. Do you stay invested and engaged? Do you just sell? I think the natural inclination of many responsible investors is just don't want it in the portfolio, I'm going to get rid of it. And I think that is a possibility to do for some types of investments. But for example, it would be virtually impossible for most pension schemes to not own US Treasuries. Or to not own ExxonMobil or Tesla, the big companies, because they've got risks that they need to manage. And so exit is sometimes an option, but it's not always a clear option or a palatable option when you're balancing this risk return debate. So it's very, very nuanced. In terms of the question around what can we expect of portfolio companies, so I think good governance at the corporate level is your first backstop for investors. So we talked a little bit what's happening in Delaware, and so the SEC and some of the legal systems that kind of enforce and provide that backstop to shareholder rights. I think regardless of what's going on in those jurisdictions, companies with really strong governance can help mitigate any risks. So strong independent boards, equal voting rights, separation of chair and CEO, a strong independent chairman, those sorts of things, no matter what might be happening in the political local context, can actually be a bit of a bulwark and try and support shareholder rights. So we've seen a little bit of this with the debate in the US around anti-DEI. There were many companies with, I would say, weaker governance that just immediately just backslid and said, oh, we didn't mean all that diversity nonsense. Yeah, oops. Whereas the more well-governed, the more stakeholder accountable companies, they may have stopped shouting about it, fair enough, but they didn't necessarily backslide. It just kind of went into the background. And when you actually spoke to them privately, they were continuing doing what they're doing. And so I think good governance can help protect you from those risks. We talked about the jurisdiction of incorporation, how that matters, and that really determines your recourse if something goes wrong. So the China example, variable interest entities, and the knowing what your rights are in that legal jurisdiction is really important. Companies are rightly scared to speak up for fear of reprisal, right? And we understand that, right? We don't want any of our portfolio companies to be in the crosshairs of a particular political intervention. That's not good for shareholder value. And so what I try to do is provide as a shareholder allyship to company actors on the inside. There's always allies on the inside. And I think our role is to try and find those people, whether it's your head of sustainability, your corporate secretary, your health and safety director, find those people and help them have a voice in the boardroom. They will be advocating for these things in their company. They sometimes don't have maybe the voice, the profile, or it's not their time. So as shareholders, we can try to find those allies, and as we can interject at the board level and provide them with that support. So again, I think it's really important that shareholders stay engaged in this issue. You don't have to be political, but I think recognizing good governance absolutely is your sort of last port of call, I guess, in a situation where you're seeing democratic backsliding.
Thank you so much. I want to turn to our audience now. So again, a reminder to everyone, there's Q&A button, Q&A function in Zoom that you can use. We have a couple in there already. While we wait for people to put in more, I get the moderator's privilege of talking about the ITUC's work in this area a little bit. I will drop some links into the chat for everyone to follow up more, but the ITUC has been very keenly interested in this for quite a while, especially the democratic backsliding, the effect on workers' rights, obviously, as trade unions. We did a comparative analysis of the VDEM data with our own Global Rights Index in 2024 when we had this mega election year. We've also started a report, perhaps a little more controversial, called The Corporate Underminers of Democracy. And this will be our third year in 2026. And what this is an ongoing project where we look at market-leading companies that we view as emblematic of the adverse impact on democracy. And we, of course, as trade unions, talk about democracy at work, in societies, in global institutions. And particularly while we're looking at all manner of sins, we are looking at companies that have platformed or financed sort of anti-democratic and authoritarian political forces and are subject to active complaints, whether that's from trade unions, social movements, environmental movements, etc. And the list, it relies on publicly available news reports and research, as well as consultation that we do with a variety of partners from corporate observatories, corporate watchdogs, trade union partners at all levels around the world, and research institutes. And then we use a tool that we've developed to sort of data scrape and find the relationships between these companies, their executives, and some of these anti-democratic actors. To date, we've named a few companies to the list. I don't think you'll be surprised by most of the names, but these will be companies like Amazon, Glencore, Exxon, Blackstone, Meta, Tesla, we've already heard on the call, SpaceX, Palantir, etc. So this year we'll be preparing another list. And one concrete thing that investors can do with companies like this is to review whether you hold the companies in the corporate underminers list in your portfolios and to engage with them. In some cases, working through some partners, we have managed to get responses from a few companies on this. In most cases, not, of course. So you're welcome to reach out to the ITUC, to me, if you want to learn a little bit more about this, or to the CWC, who we regularly discuss this work with as well. So now let's turn to some of the questions. We have two in the function right now, so I'm going to take them in the order that they came in. Some of these are comments or questions, so I'll read them, and then Lena or Ashley, if you'd like to come in, feel free to just unmute and jump in. The first from Janice is a comment saying, democratic backsliding in the U.S. is already affecting pension schemes internationally. She said she's been appalled at the wholesale dumping of voting policies on trade union rights, equality, et cetera, by fund managers operating in the UK that are linked with the US. Maybe I'll go through each question and then you can jump in to decide which you'll answer to. The next coming from Sheila, upholding labor rights is critical to a robust democracy. Given that there are so many labor rights abuses in the supply chain of portfolio companies, how can investors encourage their investees to do better? And then finally, maybe we're getting more in, so I'll do three, and then we'll turn back, and then I'll do the final. This one from an anonymous submission. Given the investment risks associated with democratic backsliding, do you see a role for investors in policy advocacy, and what would that look like in practice? So let's start with those three. Any reflections, Lena, please?
Well, I'll jump in on that, especially on that last one, which is to say that obviously we can think about investors who are investing in sort of government bonds, right? Either at the local level, or of course at the sovereign national level, as well as investors in corporate entities, right? And so that probably is going to it looks different, maybe what you want to do, but I find it striking that if you read the financial press, this week it's a lot of it's about the UK, right? But you see frequent reference to the so-called bond market vigilantes, right? And so, this notion, which, by the way, there's been academic debate about whether or not they actually have the amount of power that they're claimed to have, right? But the claim there is that, the bond markets, when they react negatively to fiscal policy, they don't like what a government is doing. They can sort of even, for the UK or France, right? They can sort of force the government into policy change, right? People like to talk a lot about Liz Truss, but people have been talking about this since Francois Mitterrand's U-turn in the early 1980s, right? And so there's this idea out there that you have this kind of this voice that comes as a result of your sort of, what you can do in terms of trading those assets in the secondary market, right? You decide that, you need a higher risk premium to hold British gilts. So I think it's really interesting that is like it's kind of juxtaposed with this sense sometimes that, well, you're powerless in the face of democratic backsliding, right? And so I think one might again sort of, obviously, to the extent that one is willing to sort of vote with one's feet, right? Ashley's right. Obviously, it's hard to say we're not going to hold U.S. Treasuries, but it might be worth saying, we're kind of reconsidering the weighting of U.S. Treasuries in our portfolios. Given that, we are worried about reductions in transparency. We're worried about reductions in Fed independence, right? And so I do think there's maybe more of a voice opportunity out there than we sometimes like to think.
Yeah. And I might just add, I think, we've had conversations like we run money market funds. So these are like short-term kind of cash-like funds. And we have said to the fund manager, do you think there's appetite for money market fund without US government debt? And they're like, actually there might be. So, those conversations absolutely do happen. I might comment on the voting one. Yeah, I think we have seen a real shift from US focused or asset managers who are owned by US firms. Probably a shameless plug from Royal London, which is we are absolutely not changing our voting policy one bit. We are actually doubling down because we think this is really important structurally, as I talked about. And so I think we have the benefit of being owned by our members and we have the benefit of being owned by a long-term mutual that does think longer term and not just the short term. And I think maybe also commenting on Lena's point as well, I think in the bond vigilante space, it is probably unused as a tool. I think they are very short term in their thinking, right, Lena? I think if you could get the bond vigilantes to actually think longer term structural, that would be a great win, actually. I think if you could shift that a little bit. And then I might just pick up the second question, I think, which was around, has it disappeared now? I'm just going to have a quick look. Labor rights. So, yeah, I think I think engagement is the way to get companies to think about their investees. So, unrelated specifically to democratic, well, it's not unrelated actually. I sit on the board of a funny enough, Dusty, a mining assurance standard called the Initiative for Responsible Mining Assurance. And part of that is looking at getting mining companies to really enforce really strong labor rights and then getting that independently assured. And as investors, we are supporting that initiative because we know in many markets where mining happens, there isn't the level of democratic systems, there isn't the rule of law, there isn't the regulation. And so we think as shareholders, it's in our interest to make sure that that happens at the corporate level and at the mindset level, and not necessarily because it's going to happen because government tells the mining company to do it. So there's many other examples, whether it's in the textiles industry or whether it's in the oil and gas industry, where the reality that there isn't those sort of democratic systems in place, your opportunity to engage with companies to try and get companies to do something in a better way, I think, is really strong.
I'll just jump in real quick to say on the labor piece. Many years ago, after the collapse at Rana Plaza in Bangladesh, I did some work where we looked at we used data on shipments of apparel, and we looked at the kinds of firms that seemed to sort of still be sourcing in Bangladesh and whether they had sort of participated in the Accord for Building and Fire Safety, right? And so we were thinking about what kinds of firms are kind of willing to sign on to these initiatives that are meant to protect workers from the most hazardous conditions. And what we found was that, to the extent that a firm was more public facing in terms of kind of branded products, then you were more likely to get involvement in that standard. And also to the extent that firms were publicly held, right? And so I think there is an opportunity, right, to the extent that your investors are aware of these issues and sort of, as Ashley's suggesting, kind of, providing some positive pressure in that direction. That is something that can lead to some improvements.
Thank you both so much. We have three more, and I think these will be our final three. The first, in terms of, this is a public versus private efficacy question. In terms of selecting tactics to defend democracy, do you think it's preferable for investors to do something like issue a statement in support of democracy in the public domain, or to do targeted engagements with specific companies or regulators or legislators, maybe in the private domain? The second is, given the discussion, I think Lena brought this up, on Hirschman's exit, voice, and loyalty, what practical levers do you see as the most effective for large institutional investors to exercise? Voice, so I think related to this, in addressing governance or political risk without defaulting to divestment. And then finally, related to the labor rights and DEI policies, are the threats to climate policy. And do you see this linked to the larger question? And I think that one, Ashley, I'll be interested in you, because in your piece you mentioned sort of the foundational nature of the democracy question and whether anything else can be delivered without it. So we're talking tactics, we're talking levers, and we're talking the intersectionality of all of these different issues. Who would like to jump in first?
I can start. I'll start with the third and then maybe answer the first one. So yes, everything is interrelated. So labor rights, DEI, and climate's related, absolutely. One of the things I've been thinking deeply about, and I don't have a solution yet, but I have written a piece on, is how do we actually lean into the populist debate? So I sit in the sustainability world. We love using acronyms like ESG and DEI and net zero, and they've got all politicized, and you get this real visceral backlash, even from, you know, family members of mine, or, you know, people we see on the street. And what I'm thinking about is, how do we get to the core of the issue, which is people's lived experience? People are feeling unhelped, unheard. They're feeling they've got unequal access. They're feeling that the system isn't working for them. How do you dig into that and change the language? Because actually, I think the outcomes we're all seeking are probably the same. So I don't know if that was an answer to the question, but I do think all of these things are related. I think the rise of populism is undermining some of our traditional campaigns. And for us as sustainability people, I think we need to have a real hard think about, are we just creating an echo chamber amongst ourselves? Or are we actually helping to serve the actual real lived experience of our pension savers? And I haven't got the answer to that one yet, but I am having a deep think about it. And I think in terms of the first question, I think you need to do both. So I think you need to, if you can, and some institutions rightfully cannot be public because they might upset some of their client base, or other things. But if you can be public, either as an individual or strengthen numbers as a collective, I think it's important to do that. But I also do think you should couple that with targeted, private, behind the scenes engagement. At a practical level, we know, companies don't like being embarrassed. And so you need to use that public stick with intention and caution. Because if you go out with the public stick too early, you just undermine any trust that you've got. So we think quite carefully about what is going to be a private conversation and at what point do we make it a public conversation. So my answer is middle of the road, both, but hopefully helpful context.
Oh, thank you. Thank you. And mindful of time, Lane, I'm going to let you have the final word on
Okay,
these two questions.
just a couple quick things there. There is an established link in some political science research between popular individual support for kind of populist right parties and kind of concerns around climate. And so you see people who feel like their government's effort to deal with climate issues has had material costs for them, and so this kind of pushes them right to these to the political extremes. And so I think Ashley's right that we need to think about climate, but we also need to think about how to frame the kind of material cost of adaptation and mitigation, and kind of on whom in society those fall. In a broader global sense, it's possible, I think, that the war in Iran and the related increases in fuel prices lets us think a little bit more about the cost of depending on fossil fuels, right? So if you're in the global south, unless you are an oil and gas exporter, this is a very tough time, right? We see governments not having money for many other things as they try to deal with high fuel and what will be high food prices. With respect to thinking about what investors might do publicly, one angle I think could be helpful is that democratic backsliding is usually linked with reduced transparency. That is to say that governments sort of don't want to measure things, or they measure them, but they don't want to share measures. We've seen this in the US, right? Going after the Bureau of Labor Statistics because you don't like their unemployment numbers. I think from the point of view of being an investor, one can say, look, we rely on data that is, regularly collected and accurately constructed to make investment decisions. And that's not very political, right? You actually do want to have the right numbers, but it might be a little wedge then, because it does kind of relate to the broader issues around democracy and the rule of law. I'll leave it there.
What an hour. Thank you both so much for your insights, both into what is really happening and establishing some common understanding of the effects here of democratic backsliding, but also exploring with us what we can do. So a reminder to those watching, to participants, a recording of this will be available. And unfortunately, we didn't get to see any slides, but we will share the ones we have because they have some good data in them. If you're an investor interested in moving from the discussion to action, like we did today on democratic backsliding, we encourage you to connect with the Committee on Workers' Capital. One initiative that you can be part of, for example, is an investor sign-on statement that expresses support for democracy and the rule of law. You'll see in the chat, we also have links on the screen, the QR code. If you're interested in learning more about this statement or exploring other collective approaches to addressing democracy-related risks, please fill out the form that you get through the code or in the chat. On the form, you can also ask to learn more about the Labor Rights Investor Network, which is housed at the CWC. This is a global network, 58 members, 4.5 trillion US dollar in combined assets under management. The network explores the risks and benefits associated with workers' rights. We had a conversation with them about democracy just last year from the ITUC. It also looks at workers' rights to freedom of association and collective bargaining, which we heard Dusty talk about at the top of the call. And it features in-depth education sessions on salient topics like the ones we've discussed today. So I want to say thank you again to Lena and to Ashley and to Dusty for walking us through this, a tour de force. It was great. And thanks to the CWC for hosting this. And of course, to everyone that listened in and that asked questions. We're grateful to all of you as well. Thank you very much.
Thank you.